If you own crypto in the UK and your tax plan is, "I'll deal with it when I cash out," this video could save you a very expensive mistake. Because Crypto Tax UK rules do not only apply when money hits your bank account. Swapping one cryptocurrency for another, using a crypto card to make purchases, receiving staking rewards, they all trigger tax. And there are many more that many people simply aren't aware about. And from 2026, with the introduction of the Crypto Asset Reporting Framework, HMRC is getting more crypto data than ever before. This means, in most cases, it's not a matter of if the taxman will catch up to you, but when. So now it's more important than ever to make sure you're aware of the rules, get an idea of how much tax you may actually owe, and educate yourself with the strategies that can minimize tax. In part 1, I'm going to explain the rules in plain English. When crypto is taxable, and when it is not, capital gains tax versus income tax, how HMRC actually calculates profit and loss, and this can catch many people out, and let you know the biggest mistakes people make and what the penalties are. Then, in part 2, I'll focus on practical ways to legally reduce your crypto tax bill. I'll cover the key tips and strategies that can help you stay compliant while making sure you do not pay more than you need to. The big change. Crypto is not invisible anymore. The biggest myth in crypto is that because it's decentralized, it sits outside the tax system. It doesn't. And from 2026, crypto asset service providers have to collect user information and report transaction summaries to HMRC under the Crypto Asset Reporting Framework. So if your plan is, "I used an overseas exchange that is not the safety net it used to be," or if you think, "I used a no KYC provider that does not make the tax disappear," no KYC might mean one platform asked fewer questions. It does not mean there is no blockchain trail, no bank trail, no exchange trail, and no future point where those assets touch a regulated platform. A cold wallet can help protect your crypto from hackers. It does not protect you from tax law. And now, many wallets are not just storage. Some let you buy, sell, and swap inside the app. The storage might be cold, but the tax event can still be very warm. Here's the mindset shift. The question is no longer, can the taxman see everything today? The better question is, could I explain everything if they ask tomorrow? So, when do I have to pay tax on crypto? This is the sentence that gets people caught. I didn't withdraw into pounds, so I don't owe tax. Wrong. For capital gains tax on crypto in the UK, the key word is disposal. A disposal usually means you had a crypto asset and then you got rid of it. The most common disposals are selling crypto for fiat currency, swapping one crypto for another, spending crypto on goods or services, gifting crypto, unless it's to your spouse, civil partner, or in certain charity situations. Example, you buy Ethereum for £6,000. Later, it's worth £10,000. You swap that Ethereum into Bitcoin. You might feel like nothing happened because you never touched pound sterling, but HMRC sees it differently. You disposed of Ethereum at £10,000. Your cost was £6,000. That is a £4,000 gain. That gain can fall under capital gains tax. Same with spending. If you use crypto to buy a £1,000 phone, the revenue can treat that like you sold £1,000 of crypto and used the money to buy the phone. And stablecoins are not magic either. If you buy a dollar stablecoin and later spend or sell it when the pound value has moved, there can still be a gain or loss. And then there's receiving crypto. In short, if you receive crypto in exchange for some kind of service, then income tax is due. Think staking, mining, payment for work. When don't I have to pay tax on crypto? Now let's clear up the other side. Buying crypto with pounds does not usually trigger capital gains tax. Holding crypto does not trigger capital gains tax. Moving crypto between wallets you own does not usually trigger capital gains tax because you still own it. So if you move Bitcoin from Coinbase to your ledger, that is usually just a transfer. But if you swap Bitcoin into Solana, spend it, or give it to someone who is not your spouse or civil partner, you need to check the tax position. It's easy to get distracted by the value of a crypto and pay less attention to the quantity. But the quantity often is the easiest way to track if a taxable event arose or not. A simple test is to ask yourself, did the quantity I own of that particular crypto change? If yes, that most likely it's a taxable event. That one question can save you from most crypto tax mistakes. Most UK crypto investors need to understand two different taxes: capital gains tax and income tax. The difference is basically this. Capital gains tax usually applies when you hold crypto as an investment and later dispose of it for a profit. A disposal does not just mean selling crypto for pounds. It can also include selling crypto, swapping one crypto for another, using crypto to pay for goods or services, some forms of DeFi lending, or giving crypto away, unless it is a gift to your spouse or civil partner. So if you buy Bitcoin, Ethereum, Solana, or another token as an investment, and later sell or swap it for more than it cost you, that is usually a capital gains tax issue. Income tax usually applies when you receive crypto because you have earned it, rather than because you bought it as an investment. This can include crypto received as payment for work or services, mining rewards, staking rewards, referral rewards, some DeFi returns, and certain airdrops. The key point is this: if the crypto is received as a reward, payment, or return for doing something, HMRC may treat the value of that crypto as taxable income when you receive it. So the simple way to think about it is this. If you dispose of crypto, think capital gains tax. If you receive crypto as a reward, payment, or earnings, think income tax. Airdrops are more nuanced. If you genuinely receive an airdrop for nothing, in a personal capacity, income tax may not apply when you receive it. But if the airdrop is given in return for a service, promotion, work, or as part of a trade or business, it can be taxable as income. And even if income tax does not apply when you receive the airdrop, selling it later can still create a capital gain. Capital gains tax on crypto in the UK. Now let's look at capital gains tax. For the 2026/27 tax year, the UK capital gains tax annual exempt amount is £3,000. That means your first £3,000 of total chargeable gains for the tax year can be tax-free. But it is important to understand that this is not a separate crypto allowance. It is shared across your total chargeable gains for the year. So if you already use the allowance on shares, property, or another chargeable asset, you do not get another £3,000 just because the gain came from crypto. For crypto gains in 2026/27, the rates for individuals are generally 18% if the gain falls within your remaining basic rate band, 24% if the gain falls above the basic rate band. You buy Bitcoin for £12,000. Later, you sell it for £20,000. That is an £8,000 gain. If your £3,000 capital gains tax allowance is still available, the taxable gain is reduced to £5,000. If that £5,000 falls within your remaining basic rate band, the tax could be £5,000 times 18% equals £900. If that £5,000 falls above the basic rate band, the tax could be £5,000 times 24% equals £1,200. And if your £3,000 allowance had already been used elsewhere, the full £8,000 gain could be taxable. That is why crypto tax planning is not just about how much profit you made. It is also about your income level, your other gains, your available losses, and when you dispose of the asset. Income tax on crypto. Now let's look at income tax. Income tax can apply when you receive crypto as a reward, payment, or earnings. Staking is a common example. HMRC says that where staking activity does not amount to a trade, the pound sterling value of the awarded tokens at the time of receipt can be taxable as miscellaneous income. So let's say you receive £6,000 worth of staking rewards. That £6,000 may be taxable as income when you receive it. The income tax rates for England, Wales and Northern Ireland are 0% on income covered by the personal allowance, 20% basic rate, 40% higher rate, 45% additional rate. The standard personal allowance is £12,570, but it can be reduced once income goes above £100,000. Using the simple staking example, you receive £6,000 worth of staking rewards. If you are a basic rate taxpayer, the income tax could be £6,000 times 20% equals £1,200. If you are a higher rate taxpayer, it could be £6,000 times 40% equals £2,400. If you are an additional rate taxpayer, it could be £6,000 times 45% equals £2,700. How crypto is taxed twice in the UK. This is where people often get confused. They think, wait, if I pay income tax when I receive the crypto, do I get taxed again when I sell it? The answer is potentially yes, but not on the same amount. Let's continue the same staking example. You receive staking rewards worth £6,000. You are a higher rate taxpayer, so the income tax could be £6,000 times 40% equals £2,400. That income tax is based on the value when you received the tokens. Now let's say you keep those same tokens. Later, they rise in value and you sell them for £10,000. For capital gains tax, HMRC is not taxing the original £6,000 again. That £6,000 has already been treated as income. Instead, capital gains tax looks at the growth after you received the tokens. So the calculation is sale value, £10,000. Value when received, £6,000. Capital gain, £4,000. If you are a higher rate taxpayer and the gain falls above the basic rate band, the CGT rate would generally be 24%. So, if your capital gains tax allowance has already been used elsewhere, the CGT could be £4,000 times 24% equals £960. Income tax on receipt, £2,400. Capital gains tax on later growth, £960. Total tax, £3,360. Income tax applies to the value when you receive the crypto. Capital gains tax can then apply later, but only on the growth after that point. That is why crypto record keeping matters so much. You need to know when you received the crypto, what it was worth in pounds on that date, and what it was worth when you later disposed of it. That's why crypto tax UK planning is not just about how much profit you made, it is also about when you make it. The pooling rules. Now, how does HMRC calculate the profit on a coin? How do they match the cost price with the sale price? Maybe you bought and sold the same coin many times. First, when receiving crypto, it's calculated using the spot rate value in pounds at the time it was received. Second, in terms of calculating profit or loss in terms of capital gains tax. HMRC uses pooling rules. Think of each crypto like a separate pot. One Bitcoin pot, one Ethereum pot, one Solana pot. Every time you buy that asset, it goes into that pot. HMRC then works out the pooled cost. So if you bought Bitcoin 3 times at different prices, you usually cannot just say, I sold the expensive one, so there's no gain. The matching order is important. First, the same-day rule. If you buy and sell the same crypto on the same day, those transactions can be matched first. Example, on the 3rd of April, you bought crypto A for £1,000 and later that day sold for £1,200, making a £200 gain. Second, the 30-day rule. If you sell crypto and buy the same crypto back within the next 30 days, HMRC may match the sale with the new purchase. Here's where people get caught out. For example, you bought a token for £7,000 on January 10th. It drops to £4,000. You sell it on May the 15th, thinking you have locked in a £3,000 loss. Then, 12 days later, on May 27th, you buy the same token again for £4,200 because you bought it back within 30 days. HMRC may match your sale against the new £4,200 purchase, not your old £7,000 cost. So the loss you thought was £3,000 may become only £200. That is a painful difference. Third, the Section 104 pool. Everything else not already matched using either of the above two rules normally goes into the main pooled average cost, where all the purchases and costs are calculated to give an average purchase cost. And that figure is then used to calculate the profit or loss when sold. For example, you bought one coin of crypto B on the 3rd of January for £500, then again on 5th January for £600, and 10th January for £1,000. Your average cost would then be £2,100, divided by 3 equals £700 per coin. So if you then sold one coin on 1st June for £1,000, your profit for capital gains purposes would be £300. Biggest UK crypto tax mistakes. So aside from the things we have already mentioned, what are some of the biggest mistakes people make? Mistake 1, the software will do everything. Tools like Coinly can be useful, but they are not magic. If you miss a wallet, label a transfer as a sale, forget a DeFi platform, or import only half the data, the report can be wrong. Mistake 2, not claiming losses. HMRC will not magically apply losses you forgot to report. Mistake 3, mixing up income and capital gains. Staking income and investment gains are not the same calculation. If you treat everything as one big profit number, you can overpay, underpay, or confuse your own accountant. Mistakes 4, not keeping accurate records. Some people don't keep detailed records, and then when they need them, it can be a headache trying to get them. Perhaps they already closed that crypto exchange account, so it's a struggle to get the transaction history. The statements only go back 18 months, or they have just forgotten what they did. This can be very time-consuming to track down the records and very costly in accounting bills. Mistake 5, just ignoring it. They won't find me. I'll be fine. Mistake 6, thinking you can just leave the UK and there will be no tax to pay. Whilst there is some truth in this, it's pretty complicated and very easy to get caught out. Definitely one to speak to a professional advisor about. We will also cover this in part 2. Mistake 7, not claiming proper allowances, resulting in a higher tax bill. Again, we will cover this in more detail in part 2. So, what are the fines and penalties? If you made a genuine mistake, fixing it early is usually much better than waiting. HMRC has a crypto asset disclosure service for unpaid crypto tax, but if HMRC believes you deliberately hid crypto gains, penalties can become severe. For deliberate and concealed inaccuracies, penalties can be up to 100% of the tax due. It means if you owed £6,000 in tax, the penalty could be another £6,000 on top, plus late payment interest. And in the worst cases where there is fraud, false documents, or deliberate concealment, HMRC can pursue criminal investigation. Most people who make mistakes are not in that category. So that's the uncomfortable part. Crypto tax, UK rules are real. HMRC is getting more data, and the "I didn't cash out" argument will not save you. But here's the good news. The same rules that catch people out can also save people money if you use them properly. In part 2, I'll show you the legal ways to reduce crypto tax in the UK, including allowances, timing, moving abroad, company structure, and much more. I'll also show you how two investors can make the same profit, but one pays thousands more tax simply because they pressed sell in the wrong way. Just to note, although we are accountants, this video is for entertainment and education purposes only. This is not personal, financial, or tax advice. You should do your own research and you should consult with a professional regarding your own personal circumstances. Subscribe for more UK crypto tax videos and to stay ahead of the taxman.